Hi everyone, this is going to cover the lecture for Chapter 2. So Chapter 2, we have 5 learning objectives in this class. One, we want to recognize what a business transaction actually is and the various types of accounts in which we will record business transactions. So there can be many accounts. A company like Google probably has thousands of accounts in its accounting system, but there are obviously categories and types of accounts that we could look at. We will analyze the impact of business transactions on the accounting equation. Just as a reminder, that's assets equals liabilities plus stockholders' equity. We'll analyze the impact of business transactions on accounts. We'll journalize, so those of you who may have heard about journal entries when you were looking into accounting, here's where we start looking at journalizing transactions and then posting them to the general ledger, or the ledger in this case. And finally, we'll construct a trial balance. So we'll look at what that means. So first, let's recognize what a business transaction is and the types of accounts in which it can be recorded. So this is really important. A lot of people struggle with just definitions in accounting. And so one of the key ones here is what is actually in a transaction? And a transaction is any event that has a financial impact on the business and it can be measured reliably. So you need to have objective information about the financial impact on an exchange. Something is given and something is received. This is really important because we're going to talk about recording each journal entry will have at least 2 line items, let's call it for now, okay? So accounting records both sides of the transaction, the giving and the receiving. And again, let's remember the accounting equation. Assets equals liabilities plus stockholders' equity. Again, this must hold no matter what. Let's do another definition. What is an account? An account is just a record of all the changes in a particular asset, liability, or stockholders' equity during some period, okay? Usually examples work best in accounting, much better than lectures. So as you work problems, hopefully this will make more sense. But for now, let's just get through some of these definitions. So let's look at some examples of assets. And as a reminder from earlier, these are economic resources that provide a future benefit. So examples would be things like cash. Cash can be a number of things. It can be money in a bank account. It can actually be paper currency that you hold in your hand, coins, things called certificates of deposit or CDs, checks. All of this would fall under cash, the category of cash. Then you can have accounts receivable. Accounts receivable is I've provided a good or service to someone, but they haven't paid me yet. So I will get some cash in the future. I have an account receivable. So if I'm your teacher and I teach you today, and let's say you paid me for every day of teaching, maybe you pay me only every 2 weeks, but now you owe me money because I've taught you something, right? So think of it like that. I will get some future cash. So I have an account receivable. There's also inventory. Inventory are goods that the company sells to customers. Here's some other examples of assets. Prepaid expenses. So the most common in your life may be if you pay rent, right? So if you pay rent, when is rent usually due? Well, for January, rent is usually due around January 1st, right? Might be January 5th or whatever the case may be, but you are paying rent for all of January, right? For the whole period. If the apartment burns down on January 4th, would you want some money back? You would, because you can't live, you paid from the 5th through the 31st, but you can't get that money back, right? You can't use up the apartment during that time. So you would want your money back. Then there's investments. So those are interests purchased and held in other companies. Most people think of things like stocks and bonds. but investments can mean a number of things, and we can go much deeper, but obviously those are the most common things right now that you might be aware of. Property, plant, and equipment, that's things like land, buildings, equipment that is owned by a company. Liabilities are debts or payables. So anytime you see this word payable, as in I'm gonna owe something to somebody, so account payable is a promise to pay a debt. The most common example of this is think of Verizon and Apple. So Verizon sells a bunch of Apple phones. When Verizon needs more Apple phones, they don't go to Apple and use a credit card. They just call Apple up and say, hey, we need another 1,000 iPhone X's. Can you please send them? Apple sends them, and then a week later, Apple sends an invoice to Verizon or AT&T or whoever for those phones. So that's an account payable. Notes payable is very similar to accounts payable, except it's actually generally a written agreement, and very often it includes interest. Here, you usually do not pay interest. Okay, but here you do pay interest. So it's really just a longer, accounts payable are usually 1 to 30 days. Notes payable is usually 30 plus days. And this is not a rule, it can vary, but that's the way to think about it. Then we have accrued liabilities. So this is a liability for an expense that you have not yet paid. So if, for example, you are my employee and you work for me today, I may not pay you until the end of the week, but the simple fact that you worked for me already today means I owe you that money. Finally, we have stockholders' equity. So what are some accounts that we'll see under stockholders' equity? Common stock. This is just the owner's investment in the corporation. Retained earnings, we've seen this already. This is the cumulative net income minus any net losses and dividends over the company's life. And finally, we have dividends. Dividends are just distributions of the company's earnings to shareholders. Most often, this is money, but you can pay out a dividend in the form of any asset, right? So if the asset is given to an owner, that's a dividend. Finally, we also have revenues. So revenues increase stockholders' equity. You get those by delivering goods and services to customers. And you have expenses. Those decrease stockholders' equity, and that's the cost of operating the business. Let's look at the impact of business transactions on the accounting equation. So the best way to do that is through an example. We'll look at this company called Aladdin Travel Inc. And we'll look at 11 transactions and see how it affects the equation assets equals liabilities plus stockholders' equity for this company, Aladdin Travel Inc. So here's the first part. On April 1st, this person and some friends start a company called Aladdin Travel Inc. by investing $50,000. In return, the business, Aladdin Travel Inc., remember this is like a separate person, the business issues common stock. That common stock shows that these people own the company. So how does that work? Well, we look at assets equals liabilities plus stockholders' equity. So under assets, the cash increases by $50,000. Under stockholders' equity, common stock increases by $50,000. What happened? What was the transaction? Issued common stock. So next transaction, Aladdin buys land for a new location, pays cash of $40,000. What gets affected? Well, it's all under assets. Your cash goes down by $40,000 because you spent it, and you purchased land for $40,000. Next, the business buys supplies on account. When it says on account, that means I will have an account payable. I haven't paid the cash right now, right? I agreed to pay the $3,700 within 30 days. So I buy supplies, I increase supplies, those are an asset account, and I have an account payable now, so I increase my accounts payable $3,700. I'm going to owe $3,700 to some outsiders. Now I perform some service and earn $7,000 of service revenue. So The $7,000 I assume comes in cash, and then service revenue increases my stockholders' equity. So my cash goes up by 7,000. My stockholders' equity, specifically retained earnings, goes up by 7,000. So cash up by 7,000, stockholders' equity by 7,000. The key thing to look at here as we're doing these transactions, the accounting equation, assets equals liabilities plus stockholders' equity, always equals, right? That must be true. Transaction 5, Aladdin performs services on account. So this is the opposite. I'm performing services on account, so the customers will pay me later. That means my cash didn't go up. What went up is my accounts receivable, right, by 3,000. And I have my revenue of 3,000 that went up. So again, assets still equal liabilities plus stockholders' equity. Now, during the month, I pay some bills. I pay $2,700 in total. Rent of $1,100, employee salaries of $1,200, utilities of $400. So in this situation, since they don't tell you, we assume that you paid it in cash. So your cash goes down by all those, down by $2,700. And then you have all these expenses that decrease your retained earnings, which falls under stockholders' equity. And again, the accounting equation still holds. Now, Aladdin pays $1,900 of the money that was owed earlier, this $3,700 that we bought supplies for. We're going to pay $1,900 towards that bill, right? So what happens? Well, our cash goes down by $1,900, and now we owe $1,900 less in accounts payable. Before we owed $3,700, now we only owe $1,800. Again, our assets equals liabilities plus stockholders' equity. Star Williams, the major stockholder of Aladdin, paid $30,000 out of her personal bank account to remodel her home. So we do nothing here. There is no entry. Why? Because if you remember back in chapter 1, we have the entity assumption. That is, the person, Star Williams, is separate from the business. So this is a personal thing for Star Williams. It has nothing to do with the business. There is no entry at all. Now, this is going back to transaction 5. If you remember, there were some services that were performed, but the customers hadn't paid us yet. Now the customers have paid $1,000 towards that account receivable. So you'll see now, before customers owed us $3,000, we're going to decrease that by $1,000 because they paid towards the account. So now they only owe us $2,000. And how did we get that $1,000? Well, the customers paid us in cash. So our cash went up from $12,400 to $13,400. Again, assets equals liabilities plus stockholders' equity. Now Aladdin sells some land for $22,000, which is the same amount Aladdin paid for the land. This is important. It doesn't make sense yet, but as we get further into the course, you'll see, because sometimes if you buy something at one price and sell it at a different price, then we have some additional parts that get affected, right? But for now, they're just keeping it simple and assuming that we just sold part of the land and it was the same amount that we paid for it. So we paid for all the land, we paid $40,000. We sold some of the land at $22,000, right? So now we have $18,000 left of land, and again, that increased our cash. And once again, assets equals liabilities plus stockholders' equity. Finally, transaction 11, we declare a dividend and pay $2,100 in cash. So what gets affected? Well, our cash goes down by $2,100, and our retained earnings go down by $2,100, because if you remember the equation for retained earnings, it's beginning retained earnings plus or minus net income or net loss, right, minus dividends equals ending retained earnings. And all of these transactions here are just broken out. So this may look a little bit busy, but really if you take a second and look over it, it's really just in a spreadsheet form. It looks at which transaction number, which accounts were affected, and by what amount they were affected, right? So if you go back to these earlier steps that we did and you compare them to this spreadsheet, you will see that each transaction represents what happened to which accounts, right? So for transaction, so let me go down to transaction, I don't know. How about transaction 5? So in transaction 5, accounts receivable was affected by what amount? 3,000. And stockholders' equity, retained earnings, was affected by 3,000, right? And that represents service revenue. And if you list this down like they've done here, you'll notice a few things. Here, you'll notice we have our income statement data. We have our revenues minus our expenses, right? So here's our income statement data. Here, we also have our statement of retained earnings data. We have our retained earnings, and we have our revenues, our expenses, and our dividends. Down at the bottom, we have the balances in all the different accounts after we take into consideration all the transactions. Well, that gives us the balance sheet data. So you can see it balances. And finally, here we can look at the cash account and all the cash effects, and we have our statement of cash flows data. So as you can see, simply taking and running these transactions and keeping tab of how they affect the accounting equation, assets equals liabilities plus stockholders' equity, allows us to get all the data we need to compile all of the financial statements. Go back and rewatch this again if it didn't make sense. Make sure you get really comfortable with this, because this is kind of the basic building block of everything that you're going to do for all of your accounting classes. And in chapter 1, we looked at the relationship with the financial statements. So if I just pull all these pieces of data, I can now create these relationships. So for example, let's look at the income statement. We're going to take revenues of 10,000, expenses of 1,200, 1,100, 400. So total expenses are 2,700. Revenues minus expenses equals net income. Where did I get all these numbers? Well, right here. My revenues, 7,000 plus 3,000 is 10,000. Here are all my expenses, right? So that gives me all the data I need. That net income number is going to go to my statement of retained earnings. So I just started the company April 1st. So my retained earnings beginning was 0. I made 7,300. That came from this calculation up here. Okay, I paid out dividends of 2,100. Where did that come from? Right here. So my ending retained earnings is 5,200. That 5,200 is going to go onto the balance sheet. That is my ending retained earnings, right? And then I have all these other data points on my balance sheet. Cash, 33,300. Again, where did this come from? Well, let's go back. Right here. There's cash, 33,300. Okay, so let's move to the next step of analyzing the impact of business transactions on accounts. So here's what's important to learn. Accounting is a double entry system. So you're going to record the dual effects, okay? That means always in every transaction, at least 2 accounts get affected. Okay, so we'll introduce this concept of a T account, okay? So a T account is basically just the name of an account, and it's a way to keep tally. Back in the day, before computers were popular, you would literally have notebooks where in the notebook, each account had its own little T account, and this is how you would keep track of transactions. And you would have a right side and a left side, okay? And they gave these sides names. The left side is called debit, the right side is called credit. Now I urge you, especially those of you who have bank accounts, in your brain, debit and credit probably mean very specific things. Try and forget what they mean, okay? Let's start fresh. All that debit means in accounting is left side. All that credit means in accounting is right side. So these are the accounting equation and the rules of debits and credits, okay? And here's what's important. The type of account will determine how to record an increase or a decrease. Here's what I mean by that. If I am increasing an asset account, I need to enter the number on the left side. I'm going to debit. If I'm decreasing an asset account, I'm going to enter the number or the value on the right side, the credit side. For liabilities, it's the opposite. Okay, to decrease a liability account, I'm going to debit it. To increase a liability account, I'm going to credit it, meaning I'm going to put the number on the right side if I want to increase my liabilities by 100. The same rule holds for stockholders' equity. And these rules hold except when they don't. So we have in accounting some accounts which are going to be called contra accounts. So look for that word here soon, that don't follow these rules. They follow opposite rules. So here is kind of a visual using the actual accounts. So if you remember, this is going back to the first transaction for Aladdin Travel. The investors invested $50,000 and $50,000 of common stock was issued. So if you remember, if you want to go back to that transaction and look, you'll see cash went up by 50,000 and common stock went up by 50,000. So now if I go back and follow these rules, cash going up means debit under assets, and stockholders' equity, common stock going up means credit. So you can see the 50,000 goes on the right side in common stock and goes on the left side in cash. So here's another way to take kind of a look at this and add the next transaction, transaction number 2. Transaction number 2, cash was used to buy land. So cash went down by 40,000, land went up by 40,000. Cash and land are asset accounts. To increase an asset account, we're going to debit it. To decrease an asset account, we're going to credit it. So you can see cash, the net balance of debits and credits is 10,000. And for land, the net balance of debits and credits is 40,000. As a reminder, there's 2 categories of income statement accounts. There's revenues and expenses, right? So broadly speaking, revenues minus expenses equals net income. That is effectively your income statement. Obviously, there'll be some more line items, but that is the general idea. And here is a visual that expands on the accounting equation. So it just shows you that assets equals liabilities plus stockholders' equity. And then it further expands stockholders' equity to show you that stockholders' equity is really any common stock plus the retained earnings minus dividends and then plus revenues and minus expenses, right? So it's just expanding stockholders' equity to show you everything that goes in here. Now, obviously, you're going to calculate retained earnings by using dividends, revenues, and expenses. But just so you know, if you see a revenue account change, that means you're affecting stockholders' equity because you're going to affect retained earnings. So here are some things to basically take a look at, okay? And the thing I want to show you for this rules of debits and credits is, again, that there's going to be some what are called contra accounts here in blue. You can see they behave differently, right? So stockholders' equity, the general rule on stockholders' equity is if I want to increase a stockholders' equity account, I put in the entry on the credit side. If I want to decrease it, I put it in on the debit side. But when it comes to dividends and expenses, we actually flip those rules. To increase a dividend, we're going to debit. To increase an expense, we're going to debit. So if I have an expense of office rent for $100, I'm going to put it on the debit side, right? My office rent went up by $100. So that expense account, I'm going to debit it. So this is an example of contra accounts, or accounts that behave differently than what the standard category would do. So let's look at some journal entries. So a journal is just a chronological record of transactions, right? It goes down in time. So January 1st, January 2nd, whatever the case may be. 3 steps to creating a journal entry, okay? Figure out each account that's affected by this transaction, okay? And classify by type. Is it an asset? Is it a liability? Is it a stockholder's equity? Figure out, is each account increased or is it decreased? In other words, are we debiting or crediting that account? And then record it in the journal. Let's look at an example. Let's go back again to Aladdin Travel and do our first transaction. The business receives $50,000 in cash, issues stock. So cash and common stock increase, right? Remember, what was the rule? Cash is an asset. To increase an asset, we're going to debit it. Common stock is stockholders' equity. To increase stockholders' equity, we're going to credit it. Here is how you would write a journal entry. So this is your journal. You put in the date on the left-hand side, and the common practice is to start with debits, which are flush with this side of the paper, this margin, right? So first you start and put in all the debits. In this case, we only have one debit, one credit. This is a pretty simple journal entry. So we have the cash debit, and then we'll usually have these columns of debit and credit. So cash gets debited by $50,000, it goes up, and common stock goes up by $50,000. Okay, it's credited. So when it's credited, you can see it's indented to the right. This makes it really easy to read. So when if I had a journal like this and I can just look down the dates and I can see where one journal entry starts and stops if you make it in this order, in this format. So next step is I'm gonna have all of these journal entries, this list of them, I'm gonna post them to what's called the ledger. The way to think of the ledger, let me go back here. The way to think of the ledger is basically like a sheet of paper that has the listing of all the different T accounts, right? So maybe the cash account, it might be the account receivable, it might be inventory, right? There could be all these different accounts, whatever they may be. So it's just basically a piece of paper that lists the T accounts. That is what the ledger is. It's after the journals are made, you're gonna post to the ledger. So here we did the journal entry, and then we're gonna take the journal entry and we're gonna put it into the ledger, right? So we're gonna show how that account was affected. In this case, cash went up by 50,000, so we're gonna put 50,000 on the left-hand side of the cash account in the ledger. And common stock went up by 50,000, so we're gonna put 50,000 on the right-hand side in the ledger of the common stock account. So if you remember, there was this graphic in chapter 1. This is a little bit of a different part of this graphic just to show you how the data gets into the system. So a transaction occurs, you analyze the transaction, you create a journal entry, and then you post things into the ledger. So let's look at that again. So back to transaction 1 for Aladdin Travel, right? We're receiving 50,000 cash, we're issuing stock to the owners. So we're debiting cash for 50,000, we're crediting common stock for 50,000, right? We just did that earlier. So what happens in the accounting equation? Your assets go up by 50,000, right? This is an asset. Your stockholders' equity goes up by 50,000. This is a stockholders' equity account. In the ledger accounts, you're putting 50,000 on the left-hand side of cash and 50,000 on the right-hand side of common stock. Let's look at the next transaction. Paid 40,000 cash for land. Well, land goes up, the land account goes up, the cash account goes down. These are both asset accounts. To increase an asset, if we have just a generic asset account, to increase it, we're going to do a debit. To decrease it, we're going to do a credit. We're using 40,000 of cash, so we're going to credit 40,000. Land goes up by 40,000, we're going to debit 40,000. And you see how the accounting equation is affected, and then we post it to the ledger accounts. So transaction 2 here gets posted here and here. And transaction 3. In this case, we buy supplies for $3,700 on account. So supplies went up, accounts payable went up, both went up. What are the rules? Well, if it's an asset account, to To increase an asset, we debit it. If it's a liability account, to increase a liability, we credit it. If you forgot that already, go back to the slide that we looked at that had the rules, or look in your book, in the textbook, for the rules of debits and credits. Okay, so they both went up by 3,700. So we're debiting supplies for 3,700, crediting accounts payable for 3,700. You know, this was a brand new company, so there's been nothing in the ledger under these accounts, so those will be the first journal entries. So transaction 3 is 3,700 debit to supplies, 3,700 credit to account payable. Transaction 4, performed services and received cash of 7,000, right? So what happened here? We received cash, it went up, it's an asset, so we debit it. Service revenue is stockholders' equity. To increase stockholders' equity, remember, if it's a normal account like service revenue, it's not a contra account, so to increase it, we do the debit side, right? That's the side that goes up. So there we're crediting 7,000 on stockholders' equity. We're debiting 7,000 on cash. And so here's how the accounting equation gets affected, and here's how the ledger accounts get affected. So take a look at this one for a second and see, can you do it by yourself? What accounts are affected? Account receivable, service revenue. What types of accounts are they? Asset, stockholders' equity. What are the rules for assets? In this case, what's happening in the account? Accounts receivable is going up. It's an asset, so it must be debited. Service revenue is going up. It's stockholders' equity. It must be credited. You have the accounting equation effect. And then when you post to the ledger, here's what happens. Debit to account receivable, credit to service revenue, a stockholders' equity account. So again, this is an asset account. This is stockholders' equity account. Now expenses. So if you remember, if you go back, expenses were one of the rules where it was a stockholders' equity contra. It behaved differently. So to increase an expense account, even though it falls under stockholders' equity, we're going to do a debit, right? So you see, we debit the expense accounts. How are we paying for these expenses? With cash. Cash is an asset. To decrease an asset, we're going to credit it. So there's the 2,700 credit. So we're going to have specific accounts for rent expense, salary expense, utilities expense. So our rent expense account went up by 1,100, so we're debiting it. Our salary expense account went up by 1,200, so we're debiting it. And our utilities expense account went up by 400, so we're debiting it. All of those were paid with cash, so our cash was reduced by 2,700. Cash is an asset, so to decrease an asset account, we credit it, and it decreases cash. Transaction 7. We pay 1,900 on the payable that we created in transaction 3. So in this case, we're going to decrease accounts payable. Before we owed 3,700. Now we're paying 1,900 towards it, right? So we're going to be left with 1,800. So our account payable to go down, accounts payable, remember, is a liability. If you go back and look at the rules of debits and credits, to decrease a liability, we need to debit it. And how are we paying off this account payable? Well, with cash. Cash goes down, cash is an asset. To decrease an asset, we credit it. So you can see how that affects the accounting equation, and then how it ends up in the ledger accounts. Right? We're updating for transaction 7. Transaction 8, remember, it was just one of the stockholders remodeling her personal home. No journal entry. This does not affect the business at all. It's not relevant at all. Transaction 9, we received $1,000 on account, meaning one of our customers paid towards the account receivable they owe us. They paid us with cash. Our cash went up by 1,000, so it's a debit. An account receivable, also an asset, went down by 1,000, so it's a credit, because both of these, this is an asset and this is an asset. So our assets went up by 1,000 and down by 1,000, so they netted themselves out in the accounting equation. And when you look at the ledger accounts, you'll see transaction 9 represented in cash and accounts receivable, which are the two accounts that are being affected by this transaction. Transaction 10, we're going to sell land at the land's cost. Remember, that's important, but we're not going to talk about that more now. We'll talk about it later. So we received cash when we sold land. Cash went up by $22,000, and we took off of our books $22,000 worth of land. Again, both of these are asset accounts. So assets went up by $22,000 from the cash, went down by $22,000 from the land being sold. And in the ledger accounts, you can see our cash effect here and our land effect here. So how much land do we have left? Well, we can say we have a net balance in our land account of a debit of 18,000, which would make sense. We would not expect to ever see a number here, because to have negative land doesn't make a lot of sense. Transaction 11, we're going to declare and pay a dividend of 2,100, if you remember. So dividends was another one of those contra stockholders' equity accounts. So in this case, our dividends went up. We're going to debit. Why? Because it's a contra account, right? So we're debiting dividends by 2,100. We're crediting cash by 2,100 because cash went down. So this is stockholders' equity, but contra. And this is an asset. So if we look at the accounting equation, our assets went down by 2,100 and our stockholders' equity went down by 2,100, right? Because remember, under stockholders' equity, we're going to have retained earnings, and part of retained earnings is minus dividends. So our overall stockholders' equity went down by 2,100. And here you go in the general ledger accounts, the cash effect, and the dividends. And you see, we just keep a tally of all the transactions and how they affect each account. So at the end of the period, we can look and see what the net balances in each account are when we net all the debits and credits. Okay, if we net the amounts, we can see that we have here, and these will be our balance sheet values. So we're going to look at the general ledger and net all the different accounts. And these things like revenues and expenses are going to go on our income statement. Dividends we're going to use to do retained earnings. And then all these other ones we're going to use for the balance sheet. But first step that we need to do, just to make sure we didn't make any mistakes when we were doing our journal entries, is what's called a trial balance. A lot of people really overcomplicate this process. So follow along closely and give this a shot, and really don't make it any more complicated. What you're trying to do is make sure you don't have any mistakes. In order for the accounting equation to balance, your value of debits must equal your value of credits. So if your total debits in the whole company are 100,000, your total credits must be 100,000. And a trial balance is just making sure that that's the case. So all you're doing is listing all the accounts and the balances. Just by convention, you're going to follow the order of the accounting equation. So you'll list your assets, then liabilities, then stockholders' equity. And this is going to show you that the debits equal the credits. Usually you prepare this at the end of the period. It's a step in preparing the financial statements, right? So it facilitates preparing the financial statements. And this is what it is. This is not overly complicated. You're just listing the accounts, assets, right? Liabilities, stockholders' equity, and you're just taking the net balance and putting it. So in this case, cash is 33,300. Where did this come from? Let's go back. Right here. Right? Accounts receivable, 2,000. Where did it come from? Right here. So that's all it is. And the point of this is at the very end, you will see that your debits equal your credits. Does that mean there's no mistakes in your financials? No. For example, if you completely forget a journal entry, your debits will still equal your credits, but you're missing some stuff. Or if you put in the same journal entry twice, as long as you put in the correct debits and credits, this will still balance, but you have a mistake in there. So this is not foolproof, but it's one way to easily catch some mistakes. The big thing in accounting, so there's these rules of debits and credits and how to do journal entries. Obviously, this isn't what you're really probably going to do if you finish college and move into the working world. The way you're going to use accounting is to do analysis. And so this book kind of provides some analysis, requirements. And one of the most common ways we analyze things in accounting is by analyzing the ledger accounts for a given company or a given account, right? So here's the kind of thought process that you need to go through. So let's say, suppose that Aladdin began May with cash of 1,000. During May, Aladdin received cash of 8,000 and ended the month with 3,000 of cash, right? That means we need to calculate how much in cash payments did Aladdin make. Well, if the ending balance was 3,000, we started with 1,000, we received another 8,000. So if we started with 1,000 and received 8,000, how much should I see in my cash account at the end? 9,000. But I don't. I see 3,000. So what must have happened? I must have made cash payments on the credit side of 6,000. Okay, so this is solving for x, and in this case, this shows you what the x equation is. So being able to get comfortable with this kind of analysis is really, really important in the class. So the math isn't complicated, but understanding what's going on to be able to do this analysis is pretty important, and you'll need to do this more and more. So here's another example looking at accounts receivable, okay? If I start with 6,000 in accounts receivable and I sell another 10,000 of stuff on account, how much should I see in my accounts receivable? 16,000. But I don't. I see 5,000. So what happened? Well, of the 16,000 there, it must be that I collected 11,000 from customers. So customers paid me 11,000. That decreased my 16,000 to just 5,000. So that's how I can figure out what my collections on account were. And again, here's the equation for solving for x. So review this and this at least a couple of times until it makes sense, right? Let's look at another one, account payable. If I start in accounts payable of 9,000, I buy $6,000 worth of stuff on accounts payable, I should owe other people 15,000 at the end. But if it shows me that I owe other people 11,000 at the end, what happened? Well, I must have paid 4,000 towards my accounts payable. So again, really important that you go back and feel comfortable with that. There's some basic ways to try and correct accounting errors, right? So a couple different things you can do. You can search for missing accounts. You can also do a couple of math tricks. If you compute the difference between debits and credits, so this is if your debits don't equal your credits, right? If you compute the difference between them, there's a few things you can do to this number. So let's say your debits were, 10,000 and your credits were 9,000. So I'm off by 1,000, right? So if I were to take this 1,000 difference, what I can do is divide it by 2, right? Or divide the out of balance amount by 9. And this might show me that I have a slide or a transposition. Basically, what a slide or transposition is a lot of times what happens in data entry, especially for putting in journal entries, is let's say somebody was supposed to put in 2100, 2100 debit and 2100 credit, but whatever happened, they were playing on Facebook, and instead of putting in 2100 on the credit, they put in 1200. So now you see there's this difference of 900. Your debits don't equal your credits. So you can do certain tricks with this 900 to figure out if this was a problem or not, right? So in the chapter, we discuss slides and transpositions a little bit more. So take a look at that. I'm not going to go into too in-depth on this, but I think it's important for you to take a look in the book just to see some tricks on how to find errors and correct errors when you're doing accounting. And we can work on some problems in class on that. Finally, we'll introduce this concept of a chart of accounts. If you go work for a company like Apple or Google, they will have a chart of accounts designed. There's some common practices. It tends to be that assets start with ones, liabilities start with twos, stockholders' equity will start with threes, revenues with fours, expenses with fives. There aren't necessarily rules, there's just conventions in the real world. Now, every company you go work for is probably going to have a very unique accounting system. So even if you become an expert through school in accounting and finance, no matter what company you go work for, there's going to be a learning curve, right? And chart of accounts here, it shows you a couple basic accounts. The reality is, if I look at a company like Google, under assets, they might have 10,000 accounts, right? They're not just going to have cash. They're going to have, JP Morgan account 1724, JP Morgan account 2476. All of these are going to be their own accounts, right? So you might have thousands, if not tens of thousands of different accounts. So again, here's a little review on what the normal balances of an account would be, right? So if I was going to look at the T account for an account, if it's an asset account, I would expect to see the ending balance, the net being a debit, because those are the positive side for assets, right? So this just kind of shows you, I would expect to see a debit. For liabilities, I would expect to see a credit. For stockholders' equity, I would mostly see credits, except for dividends and expenses. Remember, these were kind of contra accounts, so they behave differently. And here's another thing for you to kind of read through and review what decision that you need to make and what the guidelines are for that decision, excuse me. So where should the transaction be recorded? In the journal, the chronological record of transactions, right? How should an increase or decrease be recorded? The rules of debits and credits, okay? Where is all the information for each account stored? The ledger. Where should the accounts and balances be listed? Trial balance. So this is kind of a overall conclusion for this chapter. So again, chapter 2 is extremely important. Really, chapters 1, 2, and 3, comprehending those, getting comfortable with them is going to help you succeed in not only this class, but in future finance and accounting classes. So please spend extra time. Please come to class with questions, email me, whatever the case may be, but please ensure that you are very comfortable with chapters 1, 2, and 3 especially, because everything else will build on those 3 chapters.